Good morning and welcome back. My name is Monique Ward and I'll be taking you through Unit Standard 15236. The title of this unit standard is Apply Financial Analysis. The specific outcomes for this unit standard are: explain financial analysis in a business operation, calculate ratios to measure profitability and resource utilization, calculate ratios to measure viability, identify growth opportunities through financial results and report the results of financial analysis. Financial statements of a business comprises of an income statement and a balance sheet. An income statement is a detailed listing of all your income and expenses for a given period. This usually is done on a monthly basis. A balance sheet comprises of all your assets, owner's equity and liabilities for a given period. This is usually done on an annual basis. If you can recall from our last unit standard 252040, we discussed a practical example of our fast food company where we were selling hot dogs and hamburgers. We went through a detailed example of the income statement, a cash flow analysis, and our break-even analysis. In today's unit standard, we are now going to discuss the balance sheet, how that is all brought together so that we can do financial analysis in the form of ratios. So let's take a look at the format of a balance sheet. Our fast food company has assets which total 35,790. They are made up of our 20,000 Rand for our fast food stand that we had to purchase, and the bank loaned us the money, if you can recall. And at the end of the year, we had cash on hand in our bank account of 15,790. So that is a total assets figure 35,790. If you move slightly down, you then list your equity and your liabilities. That would be any money that you have invested into the company as the owner or as a shareholder. And in our case, we started the business off with 1,000 Rand in our bank. We made a profit on our income statement of 14,969 Rand. So that is brought forward as net profit or retained income. Total equity is 15,969. Then if you recall, we had a loan with the bank of 20,000 Rand, but we paid off 500 Rand a month, which totaled 6,000 Rand for the year. This results in our bank loan coming down or being reduced to a figure of 14,000 Rand. That is known as a long-term liability because it is likely that we're going to take 3 or 4 years to pay off this loan. Current liabilities, we fortunately in this example have only our tax liability that we have to pay to SARS, and that amounted to 5,821 Rand. If you can recall, companies pay 28% tax on any profits made need to be paid to SARS. So we have a provision of 5,821 Rand. Let me just refresh your memory as to how we calculated this tax provision account amount of 5,821 Rand. This is derived from the income statement. So if we go back there and we have a look, we go down to our net profit after tax figure there, and we scroll across to our totals. You will see that we generated 20,790 Rand for our net profit before tax figure, which was all our sales, less cost of sales, less our expenses for the year. And then 28% is calculated to give us the 5,821 Rand. This is the amount that we need to pay to SARS. So as you can see, our total assets amounted to 35,790, and our total equity and liabilities amounted to 35,790. So your assets and your equity and liabilities balance. So if you can recall, the balance sheet that we discussed earlier did not have any inventory or stock on hand, and it did not have any debtors. Those amounts were nil. So in our new balance sheet, what we have assumed is that you do have some stock of hamburgers or rolls or something like that at the end of the year of 1,500 Rand. And what we've done is we have said that you have a debtor now. Perhaps you're selling to a business and that business is only going to pay you in 30 days. So we split your cash on hand figure to be 50% debtors, 50% cash on hand. This is purely to show you how the ratios work later. So the two most common ratios that we're going to look at that relate to your balance sheet is what we know as the current ratio and your acid test ratio, which is also commonly known as the quick ratio. Let's have a look at the current ratio. Current ratio equals your current assets divided by your current liabilities. Your current assets are all of your assets such as stock, debtors and cash on hand. So as you can see, your total is 17,290 in this example for current assets. The second part of the current ratio is current liabilities. Where do we find that in the balance sheet? Your current liabilities are any liabilities that need to be paid off within 12 months. So in this example, we have also assumed that you have a supplier's account. Perhaps you're able to buy your rolls and your beef patties and that on an account. So 1,500 Rand has been allocated for a supplier's or creditor's account, and then the balance of the 7,321 is that tax that you need to pay to SARS that we have discussed before. So to calculate your current ratio, you take, if you can recall, current assets divided by current liabilities. And you will see that this ratio amounts to 2.36 to 1. This ratio is very good as it shows that the business is likely to be able to pay all its accounts. Another very popular balance sheet ratio is your acid test ratio. The only difference between this one and your current ratio is that we exclude stock. You only add the assets that has nothing to do with stock. So in our case, debtors and cash on hand. Those two figures is what you're going to use now for your quick ratio. And then you divide that by the same current liability amount that we used previously, which was our tax and our creditors. And this shows you that your ratio is 2.16 to 1. This is a very, very good ratio because it actually says that your accounts, you are very liquid. In other words, your money is not tied up in stock. So let's have a look at our return on assets ratio. We look for the figure for net income from the income statement and we divide it by your total assets, which is your fixed assets and current assets in your balance sheet. So let's have a look at the income statement. Your 2790 is your total net profit before tax. So net income is equivalent to net profit before tax. And then in the balance sheet, your total assets that you had was your fixed assets, the fast food stand, plus your current assets, which is your debtors, your stock, your cash on hand, and that total asset figure there is what you use for your return on assets figure. Once you calculate the percentage, in our case 56%, the higher the percentage, the better. You want to see a good percentage of return on assets because this means that the company is using its assets to generate sales. A very important ratio, especially for your investors, is your return on investment, commonly known as ROI. This time, the net profit figure is your after-tax figure, and you divide that by your total assets. So the difference between the return on asset figure and the return on investment is that we are using the net profit after tax figure. We calculate this and we see that your return on investment is 40%. This is an excellent percentage of 130% because it means that the fast food company is utilizing the investor's money exceptionally well. There are a few other ratios that can also be important for you to analyze your business, namely your stock turnover ratio. This you calculate in order to find how often your stock is turning over. So analyzing these ratios helps us to understand how our business is growing and the strengths of our business, or where we need to actually make improvements. We have now come to the end of Unit Standard 15236. My name is Monique Ward and I look forward to seeing you next time.